Investing in the stock market can feel intimidating, especially with all the confusing terms thrown around by experts. But what if I told you understanding this jargon is actually simple, and knowing these terms can significantly boost your investing success? My name is Alex, and in today's video, I'm going to break down the most essential stock market terms every beginner needs to know, in a way that's easy to understand and even easier to apply. But first, here's a quick challenge for you. Do you really know what people mean when they say bull or bear markets? Stick around because I'm about to reveal the true meaning and why getting these terms wrong can cost you money. Let's dive right in with our first term, stocks. It sounds basic, but what exactly are stocks and why do people invest in them? Think of stocks as tiny pieces of ownership in a company. When you buy a stock, you're essentially buying a small portion of that company. So if the company does well, your stocks rise in value, making you money. Sounds simple, right? But here's the catch. Owning stocks also means you share in the company's risks. So how can you manage this risk effectively and avoid losing your hard-earned money? Don't worry, we'll get to that soon. Next up is dividends, one of my personal favorite terms. You've probably heard people bragging about their dividend checks, but do you actually know what dividends are and how they work? Dividends are payments made by a company to its shareholders, usually in cash, as a reward for holding the stock. It's like getting paid for doing nothing. Pretty cool, right? But wait, here's something most beginners overlook. Why exactly do companies pay dividends, and how can you use dividends to build long-term wealth? Companies pay dividends as a way to share their profits with investors, making their stocks attractive and encouraging long-term holding. Here's the twist, not every company pays dividends. Typically, stable, mature companies like Coca-Cola or Johnson & Johnson pay reliable dividends, while younger companies tend to reinvest profits back into the business to grow faster. So, should you invest only in dividend-paying companies, or is there a smarter strategy? Well, that brings us to our next term, diversification. Diversification is simply spreading your investments across different types of stocks or assets, so you don't put all your eggs in one basket. Imagine if you invested all your money in a single stock, and suddenly that company ran into trouble. You could lose everything. Diversifying protects you against this risk, but how exactly do you diversify your portfolio effectively, especially as a beginner with limited funds? The easiest method is to invest in index funds or ETFs, which are funds that automatically hold a mix of different stocks for you. Speaking of which, what exactly are ETFs and why are they such a popular choice among beginner investors? ETF stands for Exchange Traded Fund. It's a type of fund that trades just like a stock on the stock market. ETFs typically track an index, sector, or specific theme, giving you instant diversification in a single purchase. For instance, buying an ETF that tracks the S&P 500 means you're effectively investing in the 500 largest companies in the US economy all at once. Pretty amazing, right? But here's another important question. What's the difference between ETFs and mutual funds, and why might you prefer one over the other? Mutual funds, unlike ETFs, don't trade like stocks. Instead, they're priced at the end of each trading day and often require higher minimum investments. ETFs are usually cheaper, more flexible, and easier for beginners to access. However, mutual funds might offer active management, meaning an expert tries to beat the market rather than just tracking it. But wait, do actively managed funds really outperform passive ETFs consistently, or is this a costly myth? Before we answer that, let's clarify two more essential terms, bull market and bear market. Remember earlier when I challenged you about these terms? Well, here's the answer. A bull market means stock prices are rising or expected to rise, often driven by optimism and confidence in the economy. A bear market is the opposite. Prices are falling, and investors are usually pessimistic. But why exactly do we use animals to describe market conditions? And how does understanding bull and bear markets help you make smarter investing decisions? Interestingly, the terms come from how these animals attack. Bulls thrust their horns upward, symbolizing rising prices. Bears swipe downward, indicating falling prices. Understanding these market cycles helps you stay calm and focused. Here's the twist. Bear markets aren't always bad news. In fact, smart investors see them as great opportunities to buy high-quality stocks at discounted prices. So, how can you take advantage of market downturns without getting burned? The secret lies in another crucial investing concept: dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of the market's ups and downs. But why exactly is dollar cost averaging so effective for beginners, and how can you start using it today to boost your returns? Dollar cost averaging works because it removes emotions from investing. When markets are down, your fixed investment buys more shares at lower prices. When markets are up, it naturally buys fewer shares, helping you avoid overpaying. Over time, this disciplined approach reduces your average cost per share, increasing potential profits. But here's a key question. How can you practically implement dollar cost averaging even if you're brand new to investing? One easy way is through automatic investment plans. Many brokerages allow you to automatically transfer money and invest it regularly, say monthly or quarterly, into your chosen funds or stocks. It's set and forget simplicity. But speaking of brokerages, what exactly is a brokerage account, and how do you pick the right one? A brokerage account is simply an account that lets you buy and sell stocks, ETFs, and other investments. Think of it as your gateway to the stock market. Choosing the right brokerage can significantly impact your investing success, especially when it comes to fees and ease of use. Here's a quick tip. Always look for brokerages that offer zero commission fees, user-friendly interfaces, and helpful educational tools for beginners. But what about those tricky terms you see within your brokerage account, like market order or limit order? What do they mean, and how can mastering them help you save money? A market order means buying or selling a stock immediately at whatever the current market price is. It's fast but can sometimes lead to unexpected prices. A limit order, on the other hand, lets you set a specific price you're willing to pay or sell at. It gives you more control and prevents nasty surprises, but your order might not execute if the market never hits your target price. So, which should you use as a beginner? For most beginners, limit orders are safer. They help you avoid overpaying or selling too cheaply. But here's another essential term every beginner needs to understand: volatility. You've probably heard people saying the market is volatile today, but what exactly does volatility mean? Simply put, volatility refers to how dramatically stock prices change in short periods. High volatility means bigger price swings and greater uncertainty, while low volatility means steadier, more predictable movements. Volatility isn't always bad, though. Sometimes it offers great buying opportunities. But here's an important question. How exactly do you protect yourself during highly volatile periods? One strategy is to focus on long-term investing, rather than reacting to short-term market swings. When you invest with a long-term horizon, short-term volatility becomes less significant. But what does a long-term investing horizon even mean? And why does it matter so much? A long-term investing horizon typically means investing for 5, 10, or even more years. With this approach, temporary market dips become less stressful, and you can confidently hold quality investments until they bounce back. But let's tackle another critical term every beginner should know: compound interest. You've probably heard it's incredibly powerful, but do you really understand how it works? Compound interest is interest earned on both your initial investment and the accumulated interest. Imagine a snowball rolling downhill, growing bigger as it picks up snow. That's compound interest working in your favor. The earlier you start investing, the bigger your snowball grows over time. So how exactly can you harness the power of compound interest as a beginner investor? The simplest method is investing consistently in assets that offer steady returns, like dividend-paying stocks or ETFs. The key is to start early and remain consistent. Speaking of consistency, here's another crucial term: portfolio rebalancing. It sounds technical, but it's surprisingly straightforward. But why exactly is portfolio rebalancing so important? And how can you easily do it without stress? Portfolio rebalancing simply means adjusting your investments periodically to maintain your desired asset allocation. Suppose you started with 50% stocks and 50% bonds, but stocks perform exceptionally well, shifting your balance to 70% stocks. Rebalancing means selling some stocks and buying bonds to restore the original mix. It helps you maintain risk levels you're comfortable with. But how often should you rebalance your portfolio, especially as a beginner? Experts typically recommend rebalancing annually or whenever your portfolio drifts significantly from your targets. Keeping it simple is best. Set reminders and stick to your plan. Now, there's one last term you absolutely need to know: index funds. You've probably heard investors praising them endlessly, but what exactly makes index funds so special for beginners? An index fund is designed to replicate the performance of a specific market index, like the S&P 500, rather than trying to beat it. They're incredibly popular because they're low-cost, diversified, and require almost no maintenance. Investing in index funds essentially means you're betting on the overall economy rather than trying to pick individual winners. So, why do some investors argue that index funds are the smartest investment beginners can make? Because history shows that over the long run, most actively managed funds fail to beat the market consistently, especially after fees. Index funds offer steady, reliable growth without guesswork. It's investing simplified. Let's quickly recap. Today, we demystified essential stock market terms like stocks, dividends, diversification, ETFs, mutual funds, bull and bear markets, dollar cost averaging, brokerage accounts, volatility, compound interest, portfolio rebalancing, and index funds. But here's the big question. Now that you know these crucial terms, what's your next step to start building wealth confidently? Remember, knowledge without action is useless. Take these concepts and start applying them to your investing journey today. Are you ready to put your newfound understanding to work and see real results?